we might get into it just in case I do start rabbiting on. But it's certainly been an interesting year, and it's going to continue to be some pretty interesting times for the period ahead. Once we can get this presentation scrolling down, which doesn't seem to be happening. Hang on one moment.
I'll have to look after that for you.
That's okay. No, I've got it. We're away. So financial markets in 2022 has been different from what we've seen for a long time. Major economies saw strong recoveries post-COVID, and there was supply chains that were challenged from the COVID experience as well. We're all familiar with that. Then came Russia-Ukraine war, more upwards pressure on energy and soft commodity prices, and more pressure on supply chains. And those two events really combined together to provide significant supply chain issues globally. We spent the past 20 or 30 years globalising, and it's the first hiccup we've had in that regard. So those constrained supply chains globally, combined with free and excessive liquidity from central banks, as well as a Biden fiscal policy that was perhaps poorly timed in retrospect, saw a supply and demand clash in a way that's driven multi-decade high inflation. Central banks, after fighting deflation for the past 10 to 15 years, now had to turn the boat around, and it's a slow one to turn. It's very big. And now they've begun tightening, led by the US, obviously, and their economy is perhaps further down this path than most others. So far this year, we've seen bond and equity markets correct. We've made some good progress, economically speaking. We need to make more progress, and perhaps more water needs to go under the bridge. And while we go through that period, we're on tenterhooks because we hope nothing breaks, no big cracks emerge. And this is the time when, if it's going to happen, it's going to happen. So we're treading carefully in regards to how the economies are travelling, and there's some risks, and I'll run through them pretty shortly. But as I see, macro is driving the big picture at the moment, and the key macro risks that we're looking at, obviously inflation led by the US and the way the US Federal Reserve is combating that inflation.
Okay, I think I'll go to full screen now.
The US dollar, which is a side effect of inflation. There is this saying that says, it's our dollar, but it's your problem. So we'll go into that one a little bit more detail shortly. And then obviously China is always there when it's Australia. They had an urbanization boom. They had a credit boom, property sector boom. We all are well aware, but I'll just run through some of the detail and give some perspective about where they are, because that has significant implications for our market, particular banks and resources. Then I'll look at an outlook for 2023, how we build our portfolios in Aussie equities, and then the performance of our model portfolios and our SMA. So thus far, year-to-date returns, you can see over on the left-hand chart, on the left-hand side, you've got a couple of economies eking out positive gains, and that's for idiosyncratic reasons mainly. Indonesia's got a very large population. Singapore's been a beneficiary of Hong Kong's demise. But Australia sits quite happily in the middle there. And then you see perhaps towards the right-hand side, Taiwan and South Korea, which are heavily tech-producing economies. And tech valuations have been hit as interest rates have risen. So that's not dissimilar to what you would see on the NASDAQ, for instance. So you're really seeing a reversal of what's happened over the past 10 years, where there have been great gains in growth stocks, and the economies haven't been missed in that regard as well. So the US is off quite strongly, and then Europe in the middle. But Australia's sitting quite pretty, as we've been lucky enough to be for a very long time, always at the right end of the curve. Looking at the sectors in our market, energy, obviously, we've seen energy prices rise significantly with the Russia-Ukraine war, and as well as late in the cycle, energy provides a fairly substantial inflation hedge, and that's combined with the water really add weight and cause some significant indigestion globally. But nonetheless, energy stocks are the beneficiary, coal and gas in particular, and we do have a sector in both of those areas. So they're having the time of their lives. Utilities also doing okay on rising wholesale electricity prices. And then materials have probably softened. If you looked at this chart a number of months ago, or even just a couple of months ago, materials was up there being a strong performer, but that's come back a bit more recently. Then there's the rest of the economy, perhaps financials, staples, industrials, healthcare, which we're very keen on in this current environment. They do weather the storm well, good pricing power, good market positions. And then you've got a couple of sectors towards the end which we don't participate in, being property and IT, and they've had a particularly tough year. Valuations on our markets, we've seen the ASX trade up to very high market multiples in 2020 with all the stimulus, still no signs of inflation, and you've got low interest rates, and that pushes the market PE to expand, and it expanded to 20, as you can see on the left-hand chart, which is a particularly high level. That's going back to 1993, so a reasonable time frame, and normally you would say 18 or 19 is high, but it did push 20 in those excessive stimulus conditions. And you can see the blip down just before it, where there was a very short and sharp drop to about 13 or just below 13. And that was obviously COVID. Now you can see that after 10 months of this bear market, if you want to call it 2022, we're back down to a market PE that was where we were at the COVID low. So the markets have responded. It's really the point there. The multiples that are being stocks are trading on are not expensive. Perhaps earnings haven't adjusted too much just yet. Certainly reported ones, and we do have. You would expect that multiple to be towards the lower end as rates are at the higher end. And obviously, as I'll speak to shortly, we've seen the RBA very active this year. The Australian dividend yield has normalised, and that's had a bit of a COVID experience as well, where COVID was really a case of the market multiples expanding, but dividends weren't following suit. So they have normalised, which is what you can see to the right-hand side of the right-hand chart. But we'll keep moving forward. Okay, earnings and dividends, EPS growth, which is one of the key metrics. Obviously, energy stealing the limelight, materials still having a good day in the sun with BHP and Rio still bringing in good profits on very low cost iron ore, and obviously some degree of energy exposure, not so much BHP anymore, but certainly in the coal, and that comes into the materials sector as well. So the rest of the sectors, much more moderated behaviour. These figures, have spanned 3 years, and so it does show how strong the period has been for both energy and materials, that's something to take into consideration and make sure that you're not too overweight, because often these things don't last forever, but it's certainly been a case where we've seen cyclicals perform very strongly over recent times. Looking at the dividend yield across the sectors, energy, materials, the story once again. So they are paying outsized dividends, and I wouldn't expect them to continue for too much longer. We don't know how long these high energy prices are going to sustain for. Gas is probably fairly well protected, and it looks like there's some big structural issues. So that's a big question that's yet to be asked. How long, how much stronger for longer can we see in relation to coal and gas? And that will keep that dividend yield being very, very strong. But at this point in the cycle, it's also very important to make sure that you've got a high probability of receiving your dividends. It's not just the amount of dividend being paid out, it's the likelihood of receiving it. And potential changes to that dividend, which don't really favour the share prices if they work against you. Onto the macro themes. So next slide, I think you're driving this, Lindsay. But these days in this environment, and this year is very different to the past decade or so, macroeconomic themes are shaping risk appetite more significantly than ever. This graph here will show you the consumer price index in the red and the blue. One of them's the headline and the other is the underlying. And then the green is the federal funds effective rate. So if you like, the cash rate. And this goes back through the early 1980s, where Paul Volcker gained his notoriety, where you see the chart peaking. But I guess the key point here is that we've been going through a deflationary period for a long period of time. Inflation has been a non-issue. And then over the course of this year, we've seen it rise, and perhaps even late in 2021. So right at the right-hand side of that chart down the bottom, you can see it's really stepping up. You can see the blue line being the headline inflation, including commodity and transitory factors, has led the charge. And now we're seeing, and this is very important, the underlying inflation number follow it up. And if you can see, sorry about the small chart, but the underlying is often there following the headline. So the other point to make is that the green line, which is the cash rate, has been slow to respond. I was lucky enough to have a meeting with Peter Costello last year, halfway through, and obviously inflation was the talk of the day, even though nobody was really covering it across the press or anywhere else because we hadn't seen any signs, but we all knew it was coming. And his leaving remark was, don't underestimate how stubborn and persistent inflation can be once it gets entrenched. And we've seen the Fed with their talk about transitory inflation, commodity price sourced generally, and inflation that tends to reverse itself out, such as energy prices, container ship transport prices, perhaps car prices, and then underlying inflation, which is less commodity based, more along the service end. So when wages rise, they don't ever go back down. And so that is a source of the underlying inflation. And it doesn't reverse out, it then places ongoing pressure, and inflation will appear through different sectors of the economy every different month. And you think it'll be gone and then back it'll come. So that's the fear at the moment. The Fed's been worried about deflation for so long. It takes a real change in mindset for them to start focusing on inflation. And they also need to see the data. They don't change willy-nilly, and they don't like to change the direction very often. And so they have to be very considered when they do. And that kind of lends itself to why they can often be slow in responding to the initial signs of inflation. So the Fed rhetoric at the moment, which is probably the dominant factor shaping risk appetite in markets, is that they are determined to bring inflation back under control, even if it pushes the US into recession. We've seen the US Fed raise rates at every meeting since March. They don't have meetings every month like our RBA. They're slightly longer and more sporadic, the timeframes in between, but nonetheless, every meeting, and you can see there 25 basis points, or a quarter of 1%, 0.5%, 3/4. So they started slowly, they've been ratcheting up, they've been consistent at a very solid level, and expectations for the November rate rise is 75 bips again. So the market is forming the view that they've probably done enough for now, and despite the Fed rhetoric, which remains very strong, the December meeting will see a reduction from that 75 to 50. Over here, we've seen a similar course of action. We started a bit later in May. We were probably in a slightly better condition than the US was. And our RBA started with 25 and then went to 50 basis points, and it did 4 of those. And very importantly, earlier this month, it reduced the track record of 450s to be a 25. And that was a great relief to market. And it shows that they think they've done enough for now. Whether we get another 25 in November, we'll wait and see. The jury's out on that one. But our RBA does like to make the change and then watch let the data have a chance to change and then gauge whether they've done enough. So certainly they've done some heavy lifting. They've been responsive. They've done a very good job, I believe. And I think that the heavy lifting's been done, but they may choose to raise more rates later on. But at this stage, they're not going to continue to raise rates until they see the data. So pleasing progress certainly been made by our RBA. On to the next slide. We have, hang on, I'm trying to get mine as well. We have excess liquidity. So over the past decade, we've seen deflation allow central banks to undertake quantitative easing, and that's where they buy US treasuries to push liquidity into other assets, or buy their local government bonds, depending on who's doing the quantitative easing. And by buying the bonds, that pushes that money that would be buying the bonds into other riskier assets, and it provides greater demand chasing the limited amount of assets, or the given amount of assets, let's say. So it flushes the system with a great amount of liquidity and hides all sorts of cracks. The Federal Reserve have also been very active in other ways that perhaps get less attention. The reverse repo market, for instance, they inject liquidity periodically. And then obviously we saw some, I think last night, they injected some money into US dollar swap lines with the Swiss National Bank. And I guess the hint there is UBS and Credit Suisse have a market cap that's combined that's larger than the Swiss GDP. So there is some pressures exerting themselves on those markets. Sorry, just going up screen. And so they're out there being active, providing liquidity when it's needed. And that's a very important function of central banks globally. And I think that they are very aware of it. At the moment, they are running around looking for spot fires, all central banks, and trying to do their best to make sure that nothing takes down or multiplies out into a bigger event for global markets. Now, we've had the Fed raise rates over the course of this year. Interestingly, we all thought, about a year ago that they would tighten quantitatively before they rose rates, but they haven't done that. They did begin their quantitative tightening program in July, went for 3 months on a very light level. It was announced, there wasn't a huge amount of issue, and then there's been very limited news and updates about how it's been progressing. They, at their introductory quantitative tightening rate of 47.5 billion per month, they've actually only achieved closer to an average of 20 billion per month. So they've been doing it, but they haven't been pushing markets. It doesn't grab the headlines, but that's them making sure everything's okay. And they're not being held as accountable to that.
Dom, I think you might have frozen. Oh. Sorry, everyone. I'll just try and get this sorted out.
Santos had their own share registry, and then they've gone to computer share, but it hasn't.
Sorry, everyone, just seeing what's happened to Tom there. He seems to have disappeared and dropped out. Probably don't want to hear me go through the presentation, so sorry about this. Just give us a minute.
Okay.
That's back. Okay.
We've got them back. Sorry about that, everyone.
Sorry about that.
There we are, Tom.
Yes, I should be
Dodgy
talking about blackouts, shouldn't I?
Dodgy NBN in Sydney. Okay, sorry. I didn't want to take over and try and run through your presentation. So back to you. Thanks, Tom.
No problem. Okay, so I think I remember, but I might backtrack just a little bit in case I kept on going. But the chart on the left shows the Fed balance sheet in the blue line post 2013 and how they used it post GFC. And then we have a slight reduction in the balance sheet before COVID hit. And then they went from 4 trillion to over 7 trillion in a couple of months. And post COVID, they've continued to provide more liquidity right up until really May, July this year, where they paused before they began quantitative tightening at a very gentle rate. So there is a lot of liquidity still in the system. There is a lot perhaps to come out. My suspicion is that the Fed balance sheet will never be taken down to the levels that we saw just a decade ago. I think they'll run it high, and I think it'll be part of their equipment, and they'll use it as on an as-needs basis as a wonderful tool, potentially abuse it, but I don't feel that they're going to take it all the way back, and nor do I feel that they can. And so looking at what they've been able to achieve so far, obviously they planned 47.5 billion per month. They only achieved an average of around 20 in that first 3 months while they were doing it at half the rate. And then obviously as of October, actually I think it was September, we're running it at nearly 100 billion, 95 billion per month. They won't achieve that, and they'll probably stop it early, is my expectation. And I think that's going to be a story that we'll see, hit the news wires potentially second quarter of next year. But they're just going to do it in a way of whatever the market can handle, and when the markets are strong enough, they'll do it. But thankfully, the press is not holding them to account too heavily on it. So the point there is there's a lot of liquidity still in the system. And when it does get removed, all sorts of cracks and holes do open up. And I don't think that they will achieve what they hope in relation to reducing that balance sheet. But I don't think it's a major issue either. Now, both of these things are having a direct influence on the strength of the US dollar. This chart on the left shows how it's traded in relation to the US dollar in relation to the US 10-year Treasury yield. And you can see that since around middle of this year, they've moved in sync. So the US dollar is rising on rising US Treasury yields. And it's a very clear and close correlation, and it's no surprise. Now, the Fed's rhetoric is that they've got a long way to go. And so we're seeing a strong US dollar, exert significant pressure across the globe. And foreign exchange rates move quite aggressively when they do, and they can catch a lot of economies, a lot of companies out. And so that's one of the risks that we're really seeing going on at the moment. But looking at where they are in relation to their raising rates, I mean, the US has a monetary policy transmission mechanism that is not nearly as efficient or effective as ours. And this stems down to the fact that in the US, when you buy a property and take out a mortgage for 30 years, you can fix it for up to 30 years, and many do. As you'd all know, here in Australia, as is the case in the UK, most mortgages are variable. And if you do want to fix, and obviously at certain times people do, you're only fixing for 1 to 5 years. There's no maturities longer than that. So the result of that is that more mortgages are on variable in Australia and the UK than there are in the US. So when the Australian Reserve Bank raises rates, it comes out of everybody's disposable income that has a mortgage, which is a much larger group of people in Australia on variable rates than in America, where they're all fixed. And it's only new mortgages or those that are on variable, but the habit there is to do a lot more fixed. So that means that they have to raise rates for longer and more to get the same effect than what we would get here. And I think that's a good explanation and a big part of why we've seen the Reserve Bank drop now down to 25 basis points. As where the US still has some way to go according to the Fed and market expectations. So look, with that transmission mechanism being less effective, that's going to put further exacerbations on the strength of the US, and that's going to show up against the Aussie dollar, which we've seen it trade down to 62 cents recently. But we're pretty lucky because we've got, with the Goldilocks economy, we've got energy, we've got resources. So we're surviving quite well. But there are other economies that don't have those resources in their economy, or those industries in their economy that provide a backbone. And in fact, they're very different industries. So when you look at these emerging market countries, onto the next slide, please, Lindsay. You know, a lot of them rely on tourism. So that has put them in quite a difficult spot over recent times. So emerging markets is a real risk factor as far as I see it. They have less developed economies, their financial markets are less developed, their currencies have less economic support. And that means that to borrow debt in significant value, governments and big businesses in emerging markets have to borrow in US dollars. So that means that there's a currency risk associated with their debt funding. And with what we've seen happen, obviously COVID affecting tourism, not only that, but also the local population. And then we've seen high energy prices from the Russia-Ukraine war, as well as high wheat and flour prices. So the emerging economies traditionally have a much higher use and demand and disposable income spend on fuel and on basic food ingredients such as wheat and flour. And they import all of that, and a lot of them, as you can see down the bottom, Somalia is perhaps the most affected, but 100% of their wheat came from Russia and Ukraine. So prices skyrocketed as supply was constrained very significantly. And these economies that didn't have really many industries keeping them going suddenly had their costs go up astronomically. So we've seen emerging market currencies depreciate, and at the same time, for different reasons, we've seen the US dollar appreciate. And so when you combine those two together, it's particularly difficult for these emerging markets. And the cost of servicing their debt has soared. No doubt you've heard, whether it's Turkey, Sri Lanka, Pakistan, the list is long, and they're all in distress. And it's a significant risk to the global economy at the moment. On to the next slide, we see that these kind of foreign exchange movements, combined with an economically challenging time, sees some of this risk spread to developed markets as well. Now, if you look across central banks and what they've been active for a while, but particularly this year, a lot of them have been trying to change their course. You've seen the Bank of England, Bank of Japan, all these are developed market central banks active in the markets. They're either buying sovereign debt, buying their domestic currency, or adding liquidity where it's required. And no doubt they're doing a great job, but they have to, and they are on the lookout and they are vigilant because there is a much higher risk of indigestion breaking into something deeper and causing issues on a global scale. So I think central banks are doing a great job, but they've got their hands full, let's say that much. And if we go to the next slide, a prime example that I'll go through is what we've seen just recently in the past couple of weeks. The chart there is the US dollar or the pound sterling against the US dollar as it falls down towards parity, which is pretty significant. I don't know whether we ever thought we'd see that in our lifetime, but here it is. And we've had obviously the new UK PM Liz Truss come in, promised tax cuts, and then obviously with the energy crisis and the electricity bills that we're all seeing, she's released those untargeted energy subsidiaries. So both of these are stimulus. They are inflationary. The UK is currently dealing with a high degree of inflation. So it kind of reminds me of Biden's ill-timed fiscal policy post-COVID. Look, I understand something needs to be done. It's just it's a fine balance, and I think they're doing the right thing, but it just shows how serious the situation is over there. So in order to fund those tax cuts and the energy subsidies, the Treasury needs to sell bonds. Now, the Bank of England was looking to start its quantitative tightening program, and that means that the Bank of England was also going to be selling bonds. Now, in the UK gilt market, there is a £2 trillion pound player, and that is the UK pension funds. So they're unfunded pension liabilities, and they lever their investments, which I wonder whether that practice, I'm not sure whether that'll continue in the short term or the medium term, but it might well end from this experience. So those pension funds are forced to hedge their position, and so they suddenly are selling UK gilts as well. So suddenly you've got three of the largest players in the market all selling bonds all at once, and there's not really a great appetite for them from a buying point of view. So that led to the Bank of England appropriately and acting quickly, and tip my hat to that, I do, but they did an about turn and they stepped in with a bond buying program of £65 million to provide liquidity. So instead of selling, Bank of England was now buying, and so they would buy the Treasury, the ones the Treasury are selling, and then that would also reduce the pension funds requirement to hedge and sell as well. It's still early days. There is a mixed rhetoric coming out of the Bank of England, which is curiously, well, perhaps a little bit concerning, but I do think they're doing the right thing. It was a very quick about turn that had to happen, and they did it. And I believe that they've acted appropriately. I think they're probably going to have to continue buying bonds for as long as it takes, but they're not saying that yet. And the rhetoric might get there over the course of coming weeks. Now, when you look at how this affects the rest of the UK economy, at this point in time, when this was all going down, UK banks withheld 935 mortgage products. So if you need to refinance, if you need to take out a mortgage, not available. During COVID, right in the dark days of the shutdowns, of the lockdowns, 462 mortgage products were taken off the shelves. So this was an even more extreme reaction than that. And that's because the banks can't fund them. So that obviously has ongoing systemic implications for the UK economy and property sales. So that was necessary for the Bank of England to step in. Now, they will need to provide ongoing support because there are still 600,000 fixed mortgages to expire and roll on to a variable period. And generally what happens there is a lot of people refinance and refix. And so 600,000 mortgages over the course of the second half of this calendar year, and then 1.8 next year. So there's going to be an ongoing need to support that market. And so, like I said in the US, I don't think the Bank of England is going to make much progress on its quantitative tightening, and that's okay. That's okay. I think there are bigger issues, and there'll be time for that to take place in better times. So on to the next slide, and I want to move across to China now. And we all know, and I'm sorry, I'm going to take you on a little bit of a trip down memory lane. It was a Chinese urbanization, if you recall, and this is the chart of their urbanization rate from 1980. You can see it rise very aggressively to about 2010, where it hits around 50% of Chinese are living in cities, and then it normalizes, is perhaps the word for it. And that's what's been happening and driving, or not driving, the Chinese economy since 2010. But China's economy has still been very strong. We need to understand why, and the shift, because it's been from one great day in the sun to another great day in the sun, or so it appears. So China's urbanisation level now is much higher than the global average. They're at 64, global average is at 55, obviously reduced by Africa with big populations. But nonetheless, that urbanisation period was supported by the development of the Chinese manufacturing economy and cheap labour and of offshoring. So Australian, US firms, manufacturing firms would offshore their manufacturing to China, and that was certainly a boom period for them. The urbanisation also required the development of a domestic property development industry. And we're all very much aware of this story, but just running through its foundations. And in 2011 to 2013, it's just a great line. China consumed more concrete in 3 years than the US did in the entire 20th century. So giving you an idea about how significant it is. And then in 2017, China produced more cement than the rest of the world combined. Now, the point to realise there is that Australian iron ore has certainly had its day in the sun, and that was a big driver of it. And circumstances are changing, and so we need to take that into consideration. So moving on to the next slide, where we detail, hopefully that comes up for you. I think you've gone one extra. I'm looking at a Chinese credit boom chart, Lindsay, that has a bar chart. Yeah, one down. So while he finds that, I'll keep talking, but reducing urbanisation rates has also meant reduced supply of cheap labour, increasing labour costs, which has also perhaps taken the shine off Chinese manufacturing competitiveness. At the same time, new housing demand from urbanising workers begins to stagnate along with that urbanisation rate. So to keep the wheels rolling and meet GDP targets, China needs its people to buy not just one property, but multiple properties. Now, in China, the only real asset class to invest in is property, likely by design. Prices only went one way, which was certainly very positive for the development of the industry. And we saw households, businesses, local governments, central governments all increase their debt. Now, that has been quite significant. We've also seen it further where there's been the creation of local government financing vehicles, which enable the government to take on more debt but keep it off balance sheet. So as urbanisation has slowed, they've pushed people to buy more properties to keep the property development industry alive. And that's creating significant issues. And it's also, in order to achieve that, requires a large amount of debt to be taken on. So it's been a credit boom post the urbanisation boom. And this chart here that you see, now I'm up to speed with you, shows the total loans. The bar chart that is forever increasing from left to right in the blue, that is the total loans. And you're looking at from 2000 now to 2022. And it's increasing at an increasing rate. So not only did they need to keep the property development industry alive and use leverage to do so, in order to further support the development and construction industry, they went on an infrastructure binge as well. And no doubt you've all heard of the Belt and Road Initiative announced in 2013. China's investing in infrastructure in up to 150 countries. Those targets are those projects are targeted towards Chinese needs, whether it's trade, defence, utilities. Importantly, the construction is to be completed by a Chinese firm in order to keep them growing, keep work on their plate so they can meet their GDP targets. Through this process, China became the world's biggest bilateral lender, which brings fears and comments about debt trap diplomacy, whereby because they are lending and financing big projects and infrastructure, and potentially they go bad, and potentially Chinese own those infrastructure, which we've seen in some areas of the world already, and that being able to influence the democratic process in some of these countries. But the point here is that China's debt to GDP ratio, as of the second quarter of this year, reached 273%. And that is amongst the highest in the world. And that is spread across the entire economy. It's not all government, not all local government, it's across households, businesses, the whole economy. Now, when you get to debt levels that are that high, adding further credit offers very little economic benefit. And so the Chinese are at a crossroads and they need to reinvent themselves again. And perhaps that's what we're going to see on the 16th when we get some information about China's National Congress. On to Chinese property, and just to give you a little bit of an insight of how the process works over there. And first of all, on the left side, we have the share prices of China Evergrande, which I'm sure you've all heard of now, and it's flatlined at the bottom because it's basically in administration and has been for a while. And I think the Chinese government's doing a very good job about trying to manage the deflation of the issues there. But you can see that chart, 2017, 2018, where it peaked, and then it's come off a long way. Now, the blue chart is Country Garden, which is their best quality large property developer. And its share price is very much heading in the same direction. So the share prices are showing significant amounts of stress still, even in the better quality or the top quality developers over in China. Now, to give you a quick insight into how the China property sales model works, obviously the government owns all the land. They sell land leases. I think they're about 70 years to property developers. Property developers then pre-sell unbuilt properties to home buyers. Those home buyers obviously take out the mortgage with their local banks. But at the end of it, the bank has lent out funds on an unbuilt property as security over their loan. So that is a significant risk. And that practice, I don't believe, should ever have got to that level of I don't know quite what the word for, but that is out of control, and that would not happen anywhere else in the world, and could well cause some significant indigestion in it deflating and those practices changing. And we're seeing those issues play out at the moment, where we've seen obviously mortgagees refuse to pay their mortgages, and without funds going with it, then the banks are not getting return on their investment, and so the banks then a crucial part of this, and the local governments basically own the banks, and then the local governments come in and ensure or force the property developers to make sure they're working to keep this flow working. And it's a big risk, but the point there is it should never have gotten this far in the practices. And the property developers through this period have been flushed with cash because they are pre-selling and getting all the cash, and then they book it out, and then the cost later. But they're not incentivized to complete the project, and they do have this huge cash flow windfall. And those days are coming to a close. But all of these parties wanted the property success story to keep going because they're all doing really well out of it. The local government was getting its revenues, property developers probably having the best day of all. Mortgages, home buyers loved it because the property prices kept going up, and the banks were active in the piece as well. So they were all having a great time, and prices kept going up. Prices got to a level where Chinese jurisdictions were amongst the most expensive in the world. So price to income ratios were globally topping. And it was an issue. I mean, when Evergrande starts going out buying soccer teams and doing all sorts of other things, it's indicative. They brought in the 3 red lines policy, and that was the first, and that was probably late 2020. It didn't have its effect until late 2021, and really was targeted towards Evergrande at the very least, but that was the first culprit that they were never going to save because of the behaviour that Evergrande management had undertaken. So 3 red lines, they're doing things, taking measures to deflate the property bubble, and they've been managing it for a while. It was very significant. Even those property developers that were flush for cash were writing commercial paper, so IOUs, to their suppliers. And that practice has been banned, but there was an awful lot of leverage inherent in the system. And so we don't know whether it's going to blow up. They've certainly been aware of it. They are deflating it successfully so far, and they have the ability to in China because they have much more control over their entire economy. And over there, we are seeing the PBOC, People's Bank of China, come out and provide stopgap support wherever needed. It's not a Mario Draghi will do whatever it takes and will flood the economy with whatever it needs. It's carefully targeted assistance where it's required and when it's required. And so I think they're doing a pretty reasonable job, but nonetheless, it is the largest asset class in the world, and it does have to deflate. And it's certainly been doing that, but there is more water to go under the bridge in regard to Chinese property as well. On to the next slide. Now, in conclusion, and looking at financial markets in 2023, as I said, we are 10 months into this bear market. It could well last 18. It could be shorter, it could be longer, so you take that with a grain of salt. But I would put your median expectation around that level. And as bear markets work, share markets and the asset pricing lows are generally achieved before interest rates peak. So that's an important point. And it means that we've got to be at the ready. And I think we've made good progress so far, but there's a little bit further to go. So if we see inflation settling down in the US and supply chains continuing to ease, no cracks emerging in emerging markets or Chinese property, no policy errors by the Fed, then share prices may have already bottomed at the 6,400 level. And if we see that sign, the second that we do see the sign that inflation has settled, then there'll be a Fed pivot, and that will see equity markets surge, and we'll need to act quickly. And that's a possible outcome. We may have seen the bottom, we might see easing in the short term, and we might see the Fed rhetoric change, and then boom, we're off and away. I don't know whether that's my base case, but it's certainly a possibility, and you have to take that into account. If US inflation takes an additional 6 months to begin to tame, then for that period, we run the gauntlet on those macroeconomic risks that I just mentioned. If China's debt crisis opens up, that's going to hit iron ore and it's going to hit Australian banks. In that situation, you need to act quickly, but they will not be safe in that environment. And I guess banks also may have a degree of non-performing loans that's around the corner. They're having a great day today because some analysts believe that their net interest margin expansion is just begun. But I think the jury's still out on that one. Globally, developed and emerging markets are at different stages and they will recover at different times. I think we were all very much in sync for most of the 2000s to perhaps 2010 to 2020. Nowadays, everybody's at a different stage. Australia very much looks like we're Goldilocks again, which is a line that seems to come up so often. We've been very lucky in our positioning and our market makeup and our big industry, and they've carried us through a lot of tough times. Now, as I mentioned before, central banks are doing everything they can. Monetary policy, emergency liquidity, but the economic environment remains fluid and volatility is lurking. So if we see inflation continue to hamper, then potentially we make new lows. And you need to be looking at those new lows as a potential entry opportunity, but they may not come. So you can't put all your eggs in that basket, or otherwise the market will be on its recovery and you'll be all in cash. So you need to balance up the potential outcomes and wait accordingly. So when it comes to how we construct our portfolios, particularly Australian equities, so this is the next slide, please, Lindsay. Pricing power is key. We're still positioned quite defensively. We like our defensive stocks. They can fight inflation and they can pass on higher costs. Defensive earners, we're very keen. We're happy for companies that at limited earnings risk are going to achieve a moderate, maybe high single-digit earnings per share, rather than the volatility or the risk of big swings in earnings numbers. We like our US dollar earners. Obviously, those revenues come back into Australian dollars with a stronger US exchange rate, which translates into more Aussie dollar earnings. Structural growth is probably an area where we've been more cautious and so probably more strict in what comes into this category, and with a strong bottom-up growth story that's going to be able to continue to grow regardless of the broader economic environment. So we still have a couple of those. And then we like quality growth. So strong products, near monopoly market conditions, strong competitive advantage. Use of the word moat is probably appropriate there. And then to a much more minor extent, a reopening trade, and it's really that CSL is our exposure there. We've seen reopening perhaps a little bit slow and jumpy. Qantas had a good announcement today, but I think there's still some indigestion in relation to that reopening trade, but nonetheless, it's a broad thematic that we have some exposure to in the portfolio, and it's perhaps not as entrenched as the above pillars, as we like to call them, in how we build portfolios. Now, on to the next slide. We have our model growth portfolio and how it's performed over the short term and the medium longer terms. This is obviously 30th of September numbers. And look, the point there is we've been able to maintain a meaningful alpha position over the market over a range of different environments. The SMA is the Australian Equities Growth Portfolio, and that's got a shorter time record, as you can see below. Similar numbers.
Hated it.
Similar numbers being achieved there. There is perhaps some more defensive positions within the SMA. We've got a few income names like Amcor, Macquarie Bank, and Transurban, for instance. And so it's slightly differently positioned, but either case, they use a very similar process and philosophy. We've all been together in the investment committee for a very long time. We've been running the growth portfolio for 16 years, but you can see there that short-term performance hasn't helped us out. It's been volatile markets, and those rankings are against growth, value, blend, small cap, geared, the whole market that's available on net wealth. And you can see that our short-term numbers in that period, where a certain style is more likely to achieve better returns, hasn't added, but you can see we're top quartile nonetheless in that period. And then 1 year going out to 2 years, which is probably our best time period, 3 and 5, we're right up the top end. And nobody is consistently in all of those time brackets at that level. So I don't want to talk too much about it because it's going forward, but it's been a very good result for a long period of time. And the SMA is certainly following that same path. We've come up to a year's track record in mid-December. So with that, I might see if there's any questions, Lindsay.
Okay. Thank you, Tom. All right, now, everybody, thanks very much. I like that comment there, Tom, about it's not just the size of the dividend, it's the reliability of the dividend. So I'm going to take that one under notice. Thank you, yours.
At this
and it is. So quickly, anybody up here in the top right-hand corner, there's a reaction scene. If you want to, you can sort of hit that and wave your hand. If you want to, like I've just done there, if I'd like to ask a question, so we can unmute you. Otherwise, so Tom, I'm going to put a question in summary. There obviously is a bit to look out for, but probably still some turbulent times ahead, as we've seen over the last sort of 6 months. You've sort of seen that play out for a good 6 months plus.
I'll look definitely. I think, and look, volatility can be your friend, as they say. Certainly not when you don't expect it, but when you're positioned for it, it can certainly play in your favour. So, as I said, you don't want to have all your eggs in one basket, as in be sitting, waiting to get in the market, thinking that further lows are going to come, because there is a scenario where that may not happen. But while we do think it will happen, and volatility will be around, and we'll probably test that 6,400 level. We're not too far away from it now, and we'd probably be actively buying it at 6,400 and potentially saving a little bit in case there is, an opening up and a fear and capitulation in markets, and such that people are in a position to be able to capitalise on it. And so that is certainly potentially around the corner. I don't feel like it's going to be the end of the world, and I think that we've made good progress. So I think the markets are aware of a lot of the issues. And that's priced in. So while there is a potential for a little bit further downside, we'd be actively buying, expecting near of, or the potentially the bottom of the market to be not far away. So, if we see 6,000, God forbid, that would be, I think, once in a decade type entry opportunity. But in order to get to 6,000, certain developments need to come to the light of day. And we need to obviously take that into consideration at the time. But I think downside, you'd expect some more. it's not a huge amount. We've done a fair bit of the legwork, and we might be off and racing before you know it. So you can't have all your eggs in one basket.
Thank you. Okay, now sorry about a little tech issue there in the middle, but at least we got that sorted out. So we will put the slides and the presentation up on our Boyce and Boyce Financial Services website. So if people had some issues or they want to go back and have a look again later, that will be there loaded up over the next couple of days. And I realise now that we've run a little bit over time, so I haven't seen any questions come through. So thank you all for your attendance. Hopefully we'll probably try and do one of these in the new year, and maybe things are a little bit less fractious than they are at the moment. So thank you all again, and thank you, Tom.
Thank you, Lindsay. Thank you all.
Thanks, Tom. Thanks, Lindsay. That was great.
All right, it's done. Cheers.
Linz. Thanks, Tom.